The big banks are stealing the attention today, and when's the last time we said that? But we can't overlook our friend tech and the triple Qs in Market Navigator.
I mean, it's arguably the most important part of the market, right? So let's check this out. The major indices are at or very near their record highs right now. But one of our traders thinks that it's prudent with this environment to take out a little bit of downside risk and insurance at this given moment. So joining us now with the trade and the reason why is Jeff Kilburg, the founder and CEO of KKM Financial. He is, of course, also a CNBC contributor. So, Jeff, thank you very much for being here with us right now. A notched record for the S&P 500, a notched record for the Dow Industrials today. We're about 2% or less than away from the all-time highs in the NASDAQ composite. This doesn't feel like an environment where we should be taking profits, right? I mean, all the momentum's to the upside. Why are you so cautious?
Well, it feels like a little heavy to one side of the boat, Dom, and that's exactly why I want to utilize a NASDAQ future to book those profits, to synthetically hedge. And if you look at the NASDAQ futures, specifically the December contract, I think there's an opportunity to sell right here. And I think it's fascinating. If you can sell it at $20,450 in that D's contract, yes, I am risking. My stop is exactly at the all-time high, about 400 points higher. But I'm looking for a 4% drop. It sounds significant. And this is a little bit different than usual, Dom. This is a trade, but it's also a longer-term view where I just think we've seen such elevation in all U.S. equities. And it's really in the headwind or in the face of higher 10-year notes, higher VIX. See the elevation of the VIX over 20. So this is definitely a contrarian approach. But if you have exposure, and let's be clear, everyone has exposure to the top 5 holding the NASDAQ 100. It's Apple, NVIDIA, Microsoft, Broadcom, and Meta. Those 5 make up nearly 35% of just the NASDAQ 100. So therefore, I think it is time to buy some downside protection. I'm utilizing that in the futures market.
All right, so we're looking at the trade right now. The viewers are seeing it right there. The sell level right now, again, 20,450. You're targeting a 19,650 level to take profits on there. But the stop is very tight. It's only about 400 points above where we are right now. You said at those all-time highs. Why? This doesn't seem like a very high conviction type short situation. Why are you giving it just so little leeway to have any kind of a move before it perhaps even goes back to the downside?
Well, no one wants to be a hood ornament, Dom. And I think the fact that we have exposure to all these names, if you're managing $1 billion or if you're managing a $500,000 401k by yourself, you have exposure to the NASDAQ 100. It's been the leader ever since 2023. Everything AI has gone up. But the reason I have such a tight leash on this is because I think a 4% drop is absolutely plausible. All the uncertainty, we haven't seen anything. It's almost, I'm not whistling by the graveyard by any means, Dom, but it feels like everyone's holding their breath right now. Why is the market continuing to melt up? Well, that in itself gives me reason to have pause. And by having this is a very loose stop, actually. I'm looking for a 2%, which in the NASDAQ 100 world, in the futures market, is quite wide. But I'm looking for a 4% drop, which, as you know, could happen in a trading session or two.
All right, and then one last question. I mean, Kelly and I have talked about this in the past. The size of futures contracts are massive. The amount of leverage you use is massive sometimes between the big contracts and the E-minis. There are also micro E-mini contracts on the NASDAQ and elsewhere as well. So why are you using the E-minis versus the micros, and what exactly is the main difference?
Well, my portfolio is a little larger, so I want to utilize the E-mini futures here in the NASDAQ 100. But you're absolutely right. If you want 1/10 of the exposure, use the micro. It's a little hard to remember the mini and the micro, but that micro is a much smaller exposure on hedging. And you've seen institutions, Dom, utilize futures for decades upon decades. This is an institutional high horsepower tool. It's a power tool. That's why the micro really allows people who have maybe under $500,000 to hedge that out, because when you do see risk happen, there's nothing better than owning or shorting futures to really have that realized insurance in place.
All right, Jeff Kilburg at KKM, thank you very much. Have a nice weekend, sir.